Welcome to the GrowthWise 2020 budget update, delivered last night by our lovely Treasurer Josh Frydenberg.
Always an exciting time to be an accountant on budget night.
It is.
All right, let's get cracking into what was actually announced. There were a few exciting things for small businesses, maybe some other things that we would have loved to see, but let's start with what's actually happening with the budget. We're obviously going to be in a deficit.
For quite some time, and I think the motto of the government is to spend, to pass that money on to the Australian public and get them to spend to regrow our economy because it shrunk so much in the last 6 to 12 months because of COVID.
So probably the most exciting stuff for small business is all around the incentives for hiring. So the first one was hiring apprentices, which is always a fun thing. So an apprentice wage subsidy has been introduced for any new apprentices that were hired basically from the 5th of October. So if you hire a new apprentice or you hire an apprentice who had an existing apprenticeship but was let go for some other reason, you're due to get 50% of that apprentice's wages back, capped to a maximum of $7,000 per quarter, and that basically starts now and goes all the way through to the 30th of September 2021. So that's paid in arrears, similar to what the existing apprenticeship rebate that was announced in March earlier this year was. So in effect, from now till the 31st of December, you would continue to pay a new apprentice as per normal, and in January you would receive 50% of that apprentice's wages back as a subsidy, and that will continue for the next 3 quarters after that as well.
It's a pretty big incentive for an employer to put on an apprentice.
Certainly, if you think about it logically, you can effectively have 2 apprentices for the price of 1 over this next 12 months.
2 for 1. There was also another announcement about JobMaker.
Yeah, so this budget obviously is all designed around hiring people, and JobMaker is really designed about hiring young Australians, so aged between 16 and 35. And as an employer, if you hire someone between 16 and 29 who has been on job seeker or youth allowance or parenting payment for at least 1 month out of the last 3 months, then you're going to get $200 per week credit for employing that person. And so if it's actually between 30 and 35, you're going to get $100 per week for employing someone as well. Now the ATO is going to administer this system, and I imagine it will be very similar to what we're currently doing for the JobKeeper system. Still paid quarterly in arrears, similar to the apprentice rebate. The first instalment will be paid in February. So basically you will tell the ATO how many employees you have. You will obviously report via single touch payroll the ages of those employees, and they will then administer the credit. So the criteria for this is also that you're creating a new position.
Okay.
So it's not for someone who's replacing an existing employee, it has to be for a newly created position. So again, trying to create jobs to stimulate that economy.
Excellent.
The only other thing of note there is that the employee has to work a minimum of 20 hours per week. So we're really looking there for almost full-time, or certainly at least a permanent part-time employee, in order to be able to get that credit. The credit will actually then last for a full 12 months. So you could have $200 per week for a full 12 months for employing somebody into a brand new position, an increased position in your business.
So I've had job seeker, job keeper, job maker. We've also got a job trainer out there. What's that all about?
So job trainer is actually designed to stimulate the skills gap and the skills economy. We're still waiting for a lot of information about job trainer, and obviously the states have to be involved in job trainer. This is not something from a federal level, but it'll be interesting to see that unfold, certainly in the next couple of weeks, which will be again another job thing. I wonder how many more we can actually fit in there.
That's awesome. So obviously that's a big focus of the government from this budget, is all about new jobs and being able to support businesses that are actually taking that step and employing new people.
It's quite important to note that all of these incentives are basically for people who are not continuing to receive JobKeeper. So if you're a business and you're still receiving JobKeeper, you'll continue to receive JobKeeper for this next quarter if you qualify for Extension 1, and potentially Extension 2 if you re-qualify in December for January to March. The other note is the Apprentice Stimulus that was actually announced in March for apprentices that you had and that you had as of the 1st of July 2020 will still actually be eligible for that supporting apprentices payment, which funnily enough is 50% of the apprentices' wages paid at the end of each quarter to a maximum of $7,000. So in effect, if you've got an apprentice and you had an apprentice on the 1st of July, you're either going to be receiving JobKeeper, you'll be receiving the supporting apprentices payment of 50% of their gross wages, and then anyone new that you hire as an apprentice, you'll still receive that 50% of the gross wage ongoing as well.
So that's really good about incentivising businesses to employ people, and obviously in particular young people or people that are learning. What else did they mention last night about incentivising investment and things like depreciation for small business?
So depreciation feels like it's changed 20 times in the last few years, and we have yet something new again. So yes, it is exciting. So if you purchase a piece of equipment for your factory, as an example, you get to claim that piece of equipment in full, no matter the cost. So previously, and up until the 31st of December, if you purchased a piece of equipment that cost less than $150,000, you were able to depreciate it in full. The announcement last night has made that even easier. So any assets that you purchased from yesterday actually get to be claimed in full from a depreciation perspective all the way through to June 2022. So it's important to note that this is not a handout from the government. We still need to be able to actually fund the purchase of an asset, but at least you're then able to claim that depreciation and reduce the amount of tax that you need to pay in this current financial year, rather than needing to, depreciate that over 5, 10, 15, sometimes 20 years as well. The good news about that is for small businesses as well, that's not just limited to new assets, that can also be a second-hand asset, which is fantastic, or doing something to an existing asset. So actually doing a big improvement to an existing asset. And for those people in the simplified tax system that have pooled all of their assets before, at the end of this financial year, you're going to be able to depreciate the entire pool balance in full.
Wow. So lots of tax advantages this year for asset write-offs.
Definitely. There'll be a lot of people who can afford it, so please don't think that this is a handout. You need to be able to afford it, but it is a good incentive for people to upgrade equipment, to invest in some additional things to really help their businesses grow as well.
So on the tax side of things for businesses, we're already in a new year with a lower tax rate. So the company tax rate for our small business clients is now down to 26%. There was a couple of announcements last night about being able to claim for losses. Yeah,
so this is probably something that's a little bit difficult for a lot of people to understand. If you've made a profit in, let's just say, the 2019 financial year, and you've paid $20,000 worth of tax on that profit, that's $20,000 worth of tax that you've normally just paid, and you kiss that goodbye, and obviously you get the franking credits for dividends, but that's just tax that you've paid. With things like the depreciation increasing to write something off in full, if you're a business who normally makes $500,000 worth of profit in a year, and you then go and buy something that's worth $800,000, you're likely to make a $300,000 loss. Or potentially you've had some shutdown periods and COVID's impacted your business, and you're looking to make an actual taxable loss this year. Normally you would carry forward that loss until the year that you'd made profit, and that would reduce the amount of tax that you needed to pay in that year. These loss carryback provisions effectively mean that you can offset the loss that you might make in this financial year or next financial year with the actual profit that you've made in the 2019 or 2020 year, which means if you'd paid that tax way back in 2019, you can actually get a credit for that which is a refund in this current, 2021 financial year. So effectively in August and September next year, when you would look to lodge your 2021 financial year end, so your company tax return, you can get a refund of any profits that you've paid previously, assuming you make a loss.
Okay, so all is not lost.
All is not lost.
There was another thing last night about extending and encouraging people to go into research and development and being able to get credits for that.
So there was a lot of changes supposed to be coming into place with R&D to effectively reduce the amount that people can claim, to put a cap on things, and reduce the rate overall. And that's effectively been forgotten about. And we're going back almost to the old rules, where for businesses with less than $20 million in turnover during the year, there's no cap on refunds. Their rate will be 18.5% over and above the company tax rate that they'll actually get a rebate for. And this is all coming into play on the 1st of July 2021. So good news for those companies investing in research and development.
Awesome. And there's also some specific things for different industries as well. I know we're covering a lot of this in our blog post today, but one of the notable ones was about manufacturing.
Yeah, so there's a lot happening with our modern manufacturing strategy that's been played in the media at the moment.
Sounds impressive.
There'll be a lot of additional announcements coming here, but we have basically 6 broad categories in Australia that they're trying to, really invest in from a manufacturing standpoint, and we look forward to seeing what those grants end up being, and then making sure that everyone is applying for what they need to.
Excellent. One of the other things that I picked up on last night was, because it's been such a tough year and a lot of businesses are struggling, and particularly those that are in high COVID affected areas, so our thoughts go out to everyone, especially in Melbourne, was about the insolvency reforms. Usually when a small business can't pull themselves out of a trading problem and they have no choice but to face the issue of becoming insolvent, that's usually handled by an external person, and your control over that has been removed from the day you sign up to that. You're giving up control of what you've worked so hard for. What the government announced last night, I noticed, was that they're now giving longer for businesses to respond to those nasty letters, those things called statutory demands, where it was originally 21 days, and that's now going to be increased to 6 months for a business owner to be able to respond to that. So it's a step in the right direction, and I think they're also looking at becoming more practical around the owner of the business still being involved in that process before you face full liquidation of the company. So that's important for people that are really up against the wall and feeling like they've got no other choice.
Which is great. So in normal exciting stuff, we also have some personal income tax cuts, which everyone's always very excited about. Tell us what's happening there.
Okay, so the government announced last night that the changes to the income tax rates for individuals that were announced last year to be brought in next year, they're going to pull them forward to this current financial year that we're already in. So we're looking at people that are earning upwards of $120,000 and up, actually getting an extra $2,400 extra tax. Now the mechanics of that is still being worked on, but it's likely that once this announcement has passed royal assent and is actually law, that the government will release new tax tables, which means you'll be receiving that extra tax as soon as that's passed in legislation.
Which is great. The other thing to note is they're keeping that low and middle income tax offset. The 19% bracket basically means that it goes to $45,000, so anyone earning up to $45,000 is only taxed at that 19% bracket, and the 32.5% bracket moves from an end point of $90,000 to an end point of $120,000 as well. So exciting that they've brought those things forward. There's a nice little actual calculator that we'll link to in our budget wrap-up blog post, so you can type in your income and actually get to know how much extra you'll get.
And it's also on one of our Facebook posts from last night.
It is. So tell us what's happening with superannuation funds and employees' superannuation funds.
Yeah. One of the biggest bugbears a lot of employers have is when they've decided to make the decision to employ someone, which obviously they're now being incentivised to do, finding information for an employee can be quite difficult because people just want to get in and get started and they go, oh yeah, I'll get you my super details when I can. That makes it incredibly hard for an employer to put that basic information into a payroll system such as Xero to be able to process pays normally and in accordance with the payroll laws. So what the government's announced last night is they're going to allow employers to be able to look up an existing employee's super details via the ATO and via the information that should be available on everyone's MyGov login, so that an employer doesn't have to have a default fund offering for an employee. So administratively, that's really good for an employer. It's actually good for an employee too, because if they forget, then it's really simple for them just to look up and actually get information and give it to the employer, so that that's not another piece of red tape that they have to worry about. Also in relation to employees, they announced this initiative called Your Super, which is basically designed, along with MyGov, along with STP reporting, people to get really a lot more engaged about their superannuation. The government wants you to know where your super is. They want you to be proactive about it. And so what they're going to start doing is feeding you information about the performance of your fund, about the fees that you're paying, and comparing that and benchmarking that to other super funds, so that if you don't have a super fund that's actually performing in your best interest, it's going to be really obvious to you and obviously really obvious to the super funds that aren't performing that they've got to take action.
Yeah, which is great. Now, there was literally nothing in last night's budget about self-managed super funds at all.
I cried a little bit, stayed up late for nothing.
So obviously that is actually good news in some instances, because it does mean that that landscape is not changing and it will continue with the status quo.
Yeah.
On pensioners though, they're due to get 2 additional payments.
Yeah, so exciting news for pensioners. So this includes not only people receiving an actual age pension or a carer's pension, but also, in our case, for a lot of our self-funded retirees, people that have qualified for the Commonwealth Seniors Healthcare Card will actually be eligible for 2 payments of $250. One just before Christmas, which is always good news, and another one in March. So they haven't been forgotten, and it's going to be delivered in accordance with the government's rollout on that.
Which is great. So that basically were the big announcements that have impact, certainly for a lot of our clients. Big measures around hiring, and more importantly, it's all about hiring young people, realistically. Obviously, apprentices can be whatever age you would like them to be, but certainly a lot of job maker incentives around hiring young people as well. So that's trying to stimulate the economy. The incentives around the depreciation and being able to write off in full is great, but again, so vitally important that it makes sense for your business, that you can actually fund the purchase and it's going to give you good long-term benefits. So they're the big main things. We look forward to more details about Job Trainer and anything else with a job in front of it that's going to be announced in the future as well.
Excellent. Stay tuned, we'll have the blog post out to you shortly, and also stay tuned to our socials as well for other updates.